Welcome to the deep dive. Today, we're tackling some really significant ideas sparked by Ray Dalio, the founder of Bridgewater Associates.
Right. He's putting forward this idea that we might be looking at something much bigger than just your standard recession.
Exactly. Like a fundamental paradigm shift. He's even called it a new world order.
It's a big claim. So we've got a stack of info you shared, and the plan is to unpack that.
Yeah, let's get to the heart of it. What are the factors he sees driving this? And crucially, what could it mean for, investments?
We'll be looking at the economic signs, geopolitical stuff, and how different assets are doing stocks, bonds, gold, even Bitcoin.
Great. And I'm glad you're here to help us make sense of this complex picture.
Happy to be here. It's definitely a lot to wrap your head around.
So the starting point for this was actually a YouTube video by Madeline Vos. It's quite compelling.
Oh, yes, I saw that. She does a good job connecting Dalio's warnings to what's happening in the markets right now.
She really highlights this dilemma central banks are facing, doesn't she? Trying to control inflation.
Without crashing the economy.
Yeah.
Especially with stagflation maybe lurking around the corner.
It's a real tightrope walk.
It really is.
Yeah.
Because the tools you use to fight inflation, like hiking rates, well, they slow down growth.
But if you cut rates to boost the economy, you might just make inflation worse.
No easy answers there. It's a classic catch-22 for policymakers.
And Voss also mentioned the sort of confusion and volatility around import tariffs, U.S., China.
Oh yeah, the back and forth, the reversals. It just creates so much uncertainty.
It feels like the rules keep changing mid-game. How can
Well,
businesses plan?
well, they struggle. That unpredictability, it hits confidence, messes with supply chains.
And that feeds back into prices and slows things down.
Absolutely. A clear example of geopolitics hitting the economy directly.
Okay, so then there's the bond market. We've seen yields jump up, especially on U.S. 10-year treasuries. That's significant, right?
Very significant. When yields go up, existing bond prices usually fall. That hits bondholders directly.
But it's bigger than that.
Oh, definitely. Higher yields mean borrowing costs go up for, well, pretty much everyone. Companies, people getting mortgages.
So it acts like a brake on the economy.
Exactly. A natural cooling effect. And it really throws a wrench into the traditional 60-40 portfolio.
Ah, the old 60% stocks, 40% bond strategy. Voss looked at that too.
Yeah, she pointed out it's been underperforming compared to just holding, say, the S&P 500 or NASDAQ.
And it seems like falling bond values are a big reason why.
That's likely a major factor. If 40% of your portfolio is dropping, it's hard for the stocks to make up for it.
She mentioned she'd preferred precious metals over bonds sometimes in the past.
Right, which makes sense in certain environments. It really makes you question if the 60-40 logic still holds up today.
Especially with rates rising. The whole point of bonds was safety when stocks fell, but that link seems weaker.
The correlation isn't as reliable as it once was. So yeah, if bonds are falling with stocks or just falling on their own, that 40% allocation really hurts.
Okay, let's dig deeper into Dalio's core concerns then. A big one seems to be the global monetary system itself. He thinks it's unsustainable.
Fundamentally, yes. Because of the incredible amount of debt globally, the whole system is built on it.
Voss mentioned that too, pointing back to 1971 when the dollar was decoupled from gold.
That's a key moment. It removed a constraint, allowed for more flexible policy, but also, well, it opened the door to much faster debt accumulation.
And Dalio's point is that you can't just keep piling on debt forever.
Eventually, the cost of just servicing that debt, paying the interest, becomes a massive drag. It diverts money from, actual productive uses, could even lead to defaults.
He also talks about domestic issues like political divisions.
Yeah, gaps in education, opportunity. He sees that fueling conflict and ultimately hurting national productivity.
Which is interesting because Voss then brings in AI.
Right, she kind of riffs on that, thinking about how AI might reshape jobs and maybe make those divisions even worse.
Though she's clear that's her own reflection, not directly Dalio's point on AI.
Still, it connects. Internal divisions definitely weaken an economy, erode stability. AI just adds another layer of complexity, maybe inequality if we're not careful.
And then there's the international picture, geopolitics.
Another huge concern for Dalio, tensions rising, especially U.S.-China. Maybe a shift away from that sort of America first or unipolar world idea.
And that has real economic fallout.
Absolutely. Disrupts trade, supply chains again, increases risks, military spending. It just puts a damper on global investment and growth prospects.
And Dalio, he really doesn't mince words about this. He's worried about something worse than a recession.
Yeah, he's even mentioned the 1930s as a parallel if things aren't handled carefully. The debt, the bond market issues.
He sees potential for a really severe shock to the whole monetary system, maybe bigger than 71 or 2008.
If all these factors collide, that's his fear. The system's vulnerability comes from how interconnected everything is. High debt makes shocks worse. Bond market trouble spreads fast.
He also warns about the value of money itself eroding and more internal conflict within countries.
Well, if people lose faith in their currency holding its value, they'll look for alternatives, right? That can fuel inflation. And internal strife just disrupts everything, undermines trust in institutions.
It's fascinating how his book looks at historical cycles, dominant powers, their currencies, the Dutch guilder, the British pound.
And now the US dollar. History shows these things aren't permanent.
And his analysis suggests the dollar's dominance might be weakening, with China rising.
Looking at those long cycles gives you perspective. Shifts in economic power, technology, global influence. These things drive changes in the world order and reserve currencies. China's rise is clearly part of that equation now.
Okay, so given all these pretty stark warnings, looking at Dalio's own all-weather portfolio is, well, a bit confusing maybe.
You mean the big allocation to bonds?
Yeah.
55%.
Yeah. Voss questions that too. Only 7.5% in gold, 30% in stocks, 7.5% in commodities. Seems odd given his concerns about bonds.
It does seem a bit paradoxical on the surface. But remember, the all-weather is designed to be, well, all-weather. Diversified to handle different scenarios, not just one prediction.
So maybe the bonds are a hedge against deflation, even if he's worried about inflation too.
Possibly. It's about balancing risks across potential outcomes. But it is worth noting what Voss pointed out.
That he has said publicly he's reduced U.S. bond exposure more recently.
Exactly. Favoring gold, inflation-linked stuff, even China exposure.
Yeah.
That aligns better with his cyclical views.
And he's been pretty critical of the standard 60-40 for regular investors lately.
Right. So his public statements and reported shifts suggest even he's adapting his strategy beyond that static all-weather model. Diversification, globally and across asset types, seems key.
So the core message, as Voss puts it, really comes down to trust, doesn't it?
Absolutely. Trust is the foundation. Trust in currencies, governments, international cooperation.
And if that trust erodes,
The system gets shaky. People look for harder assets, things perceived as having more intrinsic value.
which brings us to the U.S. Treasury market, the ultimate safe haven, usually.
But Voss flags potential issues there. The U.S. government is issuing tons of debt.
And are the buyers still there in the same way? Traditional buyers like other countries or even the Fed itself?
That's the question. If demand doesn't keep up with supply, yields could be pushed higher. Or
the Fed has to step in and buy it, QE style.
which could happen. But that risks expanding a money supply, fueling inflation, and maybe weakening the dollar long term.
So gold comes back into focus. Dalio, Voss, they both highlight it.
Dalio's quote is famous. If you don't own gold, you know neither history nor economics.
And we're seeing big inflows into gold funds, hitting records.
Yeah, recent data shows strong demand, and you have big banks like UBS, Goldman Sachs raising their price targets.
So Voss added a little note of caution about getting too bullish on predictions.
Always wise. Gold has historically been a store of value, a hedge. The current environment certainly plays into that narrative, but predicting exact prices is always tricky.
And it's not just investors. China's central bank is importing more gold, too.
Right, increasing quotas for commercial banks, citing strong demand amid geopolitical uncertainty. That's a significant signal on a state level.
It suggests they're also seeking safety, maybe diversifying away from the dollar.
That's a very plausible interpretation, yeah.
Weiss also mentions silver, pointing out the gold-silver ratio is really high.
Over 100, yeah. Historically, that's quite stretched.
Meaning silver looks cheap compared to gold.
Relatively speaking, yes. The ratio suggests it might be undervalued compared to gold. Could have potential upside.
Even with tariffs maybe hitting its industrial uses sometimes.
That's a factor, sure, as silver does have industrial demand. But the ratio itself is often seen as a stronger indicator for precious metals investors. And Martin Verheise's portfolio, mentioned in the sources, also had a decent silver holding.
So summing up Dalio's current advice, it sounds like, diversify globally, include inflation hedges, and keep some cash handy.
That seems to be the gist. Spreading risk geographically and across asset types, protecting against rising prices, and having liquidity for opportunities or emergencies. Pretty sound advice in uncertain times.
Okay, let's shift gears slightly.
Yeah.
Credit markets. Voss raised some concerns there, too.
Yeah, about things potentially freezing up a bit in the U.S. She cited the rejection rate for mortgage refinances.
Highest since October 2008. That date definitely catches your attention.
It does. When credit tightens, when it gets harder or more expensive to borrow, that slows everything down. Consumer spending, business investment.
And the housing market feels that directly.
Absolutely. Tighter credit, higher rates, it hits housing hard.
And the data she mentioned seems to bear that out. More homes for sale, rising delinquencies.
Yeah, a tripling of new homes for sale over 13 years, delinquencies hitting the highest in years, and Willa Middlecoop apparently noted sales are at lows not seen in almost 30 years.
That paints a picture of a market under pressure.
Definitely a cooling market. Higher rates are a big part of it, making mortgages less affordable, even if rates have dipped a bit recently.
They're still much higher than they were for years.
Oh, significantly higher.
Yeah.
That affordability challenge isn't going away quickly. It could definitely lead to more price adjustments in housing.
All right, now let's turn to Bitcoin. Voss had some analysis there too, looking at on-chain data.
She mentioned the large holders, the whales.
Wallets with a 1,000 to 10,000 Bitcoin. And they've been buying more, even as the price went down.
Yeah, accumulating on dips. That's often seen as bullish, suggesting long-term confidence for the big players. They see lower prices as a buying opportunity.
And the MVRV ratio for short-term holders.
Right, the market value to realized value. When that ratio gets close to 1.
Meaning short-term buyers are basically break-even on average.
Exactly. Voss pointed out that historically that level has sometimes been a sign the price might be bottoming out. Less pressure for those holders to sell at a loss.
Interesting. And she also mentioned realized profit and loss figures are down.
Yeah, suggesting less active selling, a quieter market, maybe building a stronger support level, perhaps around $50,000, she suggested.
It indicates less panic selling, maybe.
Could be. Fewer people taking profits, fewer people forced to sell at losses. It points toward consolidation.
There was also a point about correlation with the M2 money supply.
Some analysts see a link there. If M2 reflects overall liquidity, and Bitcoin tracks it to some extent, then based on current M2 levels, maybe Bitcoin's current price isn't out of line, or could even be a bottom. It's another macro perspective.
And finally, the technical chart pattern, a falling wedge.
On the daily chart, yeah. Falling wedges are typically seen as bullish patterns that tend to break upwards.
But technical analysis is always speculative.
Of course. Patterns offer possibilities, not guarantees. Voss discussed potential price targets, but stressed the speculative nature.
And maintaining that upward trend line from last November is key.
Crucial for the bullish case, yeah. And thinking about the halving cycle, history suggests potential for new highs, but...
But we need to see the price actually make higher highs, not keep making lower lows.
Precisely. Past performance isn't indicative of future results, especially in crypto. You need confirmation from the price action itself.
Okay, so wrapping this all up, we've gone through Dahlia's pretty serious warnings about a potential paradigm shift, debt, geopolitics, economic stability, all intertwined.
Yeah, and we've seen how those concerns might be reflected in asset performance, the bond market, credit conditions.
And we took a look at Bitcoin through various lenses, on-chain data, technicals offering an interesting alternative perspective.
It really paints a picture of a complex, challenging global environment. Dahlia's core worries about whether current trends are sustainable are definitely important food for thought for any investor.
So the final thought for our listeners, considering these potential cracks in traditional financial structures and the buzz around alternatives like gold, maybe Bitcoin, how are you evaluating your own portfolio's resilience, its diversification? What factors might you be overlooking in navigating these, pretty uncertain times ahead? Something to think about as we close this deep dive.